and then we will talk about the homework 7 assignment for Coca-Cola. But today's Monday, and on Wednesday, we're going to go over multiples. So the whole class will be on multiples. You will have an assignment, homework 8, which we do 1 week from today on multiples. And then Wednesday of next week will be the second midterm. So just to be very clear, the second midterm will be qualitative, where the first midterm was quantitative. So basically what that means is that you'll have to take the midterm during your section that you're registered for on ELMS, just like you did in the first one. You don't necessarily have to be in this room, but again, it's individual, it's open book, open notes, open computer. However, no collaboration, okay? Because you can't work together, get help on doing it. You have to do it individually, and you have to do it during the class that you're registered for. So for example, if you're registered for this section, you will have between 2 and 3:30 to take it. But make sure you take it during the time that you're registered for, unless you have a DSS accommodation that you've talked to us about previously. So I will tell you that, again, it'll just be 5 or 6 essay questions. That's it. That's the entire midterm. And anything that we've talked about the beginning half of the semester, including lecture notes that we may or may not have gotten through, anything in the book, anything that was discussed in class is fair game. All right. So, and there'll be questions similar to what I mentioned in class. So for example, when we talked about, building the model and the CFIs were constant in the out years, like why were they constant? Like, explain as opposed to just calculate. Or I'm going to give you a question like this. How would an increase in the dividend impact the operating value of the firm? Right? And the answer is it wouldn't have any impact at all, because operating value is based on free cash flow, and dividend has nothing to do with free cash flow. So that's what I mean. Like, do you actually understand what you're calculating as opposed to just do math problems? So that'll be the midterm. All right. Somebody had asked in the earlier class, like, is there a practice midterm? And the honest answer is no, because it's essay questions. So it's not like a math-based midterm. It's just really essay. So again, review the material. If you have questions about the material, please continue to ask over the next 2 weeks before we have the midterm. But nonetheless, it's going to test your analysis. Yes?
Would there be a curve in the midterm?
No. Midterms are not curved. Nothing in this class is curved. But again, you're trying to accumulate total points towards a grade, and with extra credit, effectively the extra credit this semester is the curve. So it won't be a curve per assignment, but I am curving the class by adding extra credit opportunities for you to complete. Okay? All right, good question. Other questions? Midterm is 7.5 points, by the way, just FYI. Midterm 2. Okay? All right, so again, next Wednesday, midterm 2, and then also this Wednesday, 2 days from now, the first half of the stock sim is going to be over. So again, you don't have to do anything, but at the end of day, I'll take screenshots, I'll post the rankings, give grade distributions based on the rankings. Again, you'll continue to trade from that point for the second half of the semester. So we're not resetting, you'll just continue trading on. Again, make sure you have at least 10 trades per section. And then again, after the midterm, the next class will then hand out your group assignment companies. So I'll give you an industry. Let's say our industry was beverages. It'll be different by section. Each of your teams will select a publicly traded company, Coke, Pepsi, Dr. Pepper, Snapple, Monster, etc. And then you'll do a valuation on that company. No 2 teams will do the same company, but basically that's what you'll spend the rest of the semester on. And as of Wednesday, we would have covered all 4 sections: EIC, historical analysis, the valuation, and the multiples analysis, which are the 4 parts of your group project that you'll present the first week in December. Right? So basically, that's what's coming up on the schedule. Questions about any of that? All right, so what today's going to be about is really homework 7. So over the course of the weekend, both the TAs and myself got several questions about the as-is and the other models. And based on the questions, I thought it would be actually helpful if we just all went through it together. So rather than just giving a solution, I'm going to start from scratch. We're going to walk through the model and make sure you're really clear about some of the choices you need to make as you do these models, because obviously some people were struggling with that as they went through homework 7. Okay, so here's the point. So we're doing Coke. So the first thing you should have done is you should have started with your fixed Boeing model. Okay, this was my Boeing as is. And from this Excel file, save as, and then I would put this over here in my homework 7 folder. Oh, I had a homework 7 folder. There we go. Well, I'll make a homework 7 folder and I'll put it in here. So here's my valuation model for Coke as is. All right. So next thing I would do is I would go to Bloomberg. I would go to KO US Equity. And then I'd go to FA. And under Custom, I would try and get to my exportable template for the data that we had created, including the unbilled revenue fix from the last assignment. So I come here into Model. I have 6 years of historical data for Coke and export Excel current template. So Bloomberg should then spit out an Excel file with all of the Coke data in it. Right? So before I save it, remember I need to get rid of the dashes because Excel is not going to like the dashes. So again, simplest way to do is I can copy it, edit, find, replace, and replace the long dashes with zeros. That would have replaced 26 dashes with 26 zeros. Hit OK, close, file, save as, save the file. Okay. Now I'd done this in a previous section. So this would have been my saved file for Coke, okay, with that process. So the next thing I need to do is I need to take this Coke data and I need to put it into what was previously the Boeing model, right? So I'd select the whole tab, right-click, copy, go to my Boeing model, go to this model tab, select the whole tab, right-click, paste special values. Now, here's the thing. You don't want to copy and paste, right? If you copy and paste, I'm not saying it won't work, but what will happen is Microsoft will make a link to that other Excel file. And every time you open an Excel file based on this one, it'll basically say, where's the other file? And it gets to be really annoying. So basically, if you copy across spreadsheets, just a little tip, just copy, just paste special values, which means just put the numbers in, don't make links to the other spreadsheet. That's why we're doing the copy paste special values. Okay, so nonetheless, I've updated what's now the Boeing model to the Coke model, so it now has Coke's historical data. And then the first thing I can check here is we can see the last reported year for Coke was fiscal 2017. So when I go to my assumptions tab, I need to start updating my assumptions. And my first assumption is last reported year. So again, we have some companies which have already reported fiscal 2018, so they would have their last reported year is 2018. Coke is not, so they're in still last reported year is fiscal 2017. So make sure this number is correct. All right, then I need to go to a WACC. So again, if I go back to Bloomberg, WACC, and Coke's WACC as of right now, 7.2%. Take a screenshot. Save the screenshot. And again, I'm KO-WACC. That's what I named it. I had taken it in a previous section, so I'm just going to replace that. But basically, that's my screenshot as of the time of my valuation, which again is important because given you could be doing this in a different day of the week, you might actually have a slightly different WACC. So given 7.2, come back to Excel, change that to 7.2. All right, my next screenshot is going to be DES. 2 data points. One, I want the current share price at the time of my valuation, and I want the shares outstanding. Okay, so again, I'm going to take a screenshot here. Save, KO DES. Save, replace. You won't have to replace, but again, that is my DES screenshot. So again, right now, price $45.99. Let's go ahead and put in the $45.99 price. And the other thing is the shares outstanding, 4,252.9 million. So 42, 52.9. Is that right? Yes. All right. Because again, this is a common error. If I had used Boeing share count for Coke, I'd have a lot of trouble matching the share price. So again, I need to make sure I update the whatever company I'm doing with the share count for that company. I'll get that off of DES. Now, ideally, very soon after I take the DES, I want to also take the third screenshot, which is EEO. All right. And then again, I'm going to want to save this. And this will be my KOEEO file. All right, because there's going to be two things I'll need over the earnings estimate overview. One is I'll need the forecasted revenue and EBITDAs from the analyst to help me with my as-is. But now the other thing I'll need is I'll need my EV to EBIT multiple for forward year 2 to help me estimate my G. All right, and recognize that that EV to EBIT multiple is going to be based on the current share price of the company. So if I take the DES and the EEO within a minute of each other, it's probably going to be pretty similar. If I do it 2 days apart, well, given the volatility of the marketplace, the share price might be dramatically different, which means my multiple is not going to sync up with my share price. So again, we want to take these screenshots pretty consecutively. So the multiple represents the share price, because again, it's based on the trading share price at the time we're taking the screenshot. It also allows us, again, since we're not all doing the assignment at the same time, to do the assignment at different times. All right, so with that in mind, I'll start putting in the data. So for revenue this year, 31,849. Next year, 33,073. And the final year, 34,517. For EBITDA, put in 11,379. 12,121 and 12,917.
You said those numbers can change based off of when we actually did it, right?
They might be a little different. Exactly. And that's why it's important to you guys put your screenshots in, because that's the only way that we can validate if we're grading that you might have a slightly different number because it was based on the time that you did it. Because these are real time. And if an analyst decides that, hey, I heard market-based news and I want to change Coke's revenue or profit target, I can change it anytime. Therefore, we change the estimates. All right. So now that I've done that, I next want to come in here and I'm going to eventually try and estimate my G. But before I do, I'm going to go over here to the ratios. And I need 3 initial assumptions. One is the tax rate. Right? Now, somebody had asked about this. They said, well, last year, Coke's tax rate is 82.5%. And they're like, how did that happen? Right? And the answer is, it's not like they're a French company. Right? So it's not like we have crazy tax rates. But basically what's going on here, and you guys essentially understand this, is there's a difference between GAAP accounting, which is usually straight line, and, for example, tax accounting, which is often like makers. Right? And so because of that, there can be deferred taxes. And at some point, those deferred taxes might come due. So on a GAAP basis, it doesn't look like we owe a lot, but suddenly we're paying past taxes. Also, last year, there were changes in tax policy, a lot of repatriations. So what's happening here in Bloomberg is the tax rate is literally looking at the taxes paid and dividing it by pre-tax income. All right. So if for some reason the company owes money for whatever reason to the IRS or other tax authorities, and we're just dividing it by this year's income, it doesn't matter. It's just going to calculate a tax rate. That's why for historical tax rates, they are what they are. What we really need is something that is more reasonable for what the company is going to be having going forward. That's why we're not doing averages. And ideally, we want to get guidance from the company. So that means, again, our preferred method, go to EVT. These are where we're going to get the company's conferences and earnings calls and the transcripts, which I said we should look through to see if they were giving guidance. Now, again, I am about to cheat because I have a feature in my terminal that is not enabled in yours called the Transcript Analyzer, which is just a search tool to search the templates or all these forms. So for Coke, single security, I'm going to just search for tax rate. Again, you could have done the same thing by just opening up the PDFs. But what we'll see is this is every mention of tax rate. And what matters to me is that in the fourth quarter 2017 earnings call, they guided towards, where is it in here? That's 21%. There it is.
26%.
So there was a, if you had used the third quarter earnings call where they said 26, that would be okay, such that you reference that as part of your assumptions. So if you had said in your write-up, assumption third quarter earnings call, they said 26%, but obviously in the fourth quarter earnings call, they actually revised it again to 21%. It's somewhere in here. There it is. Going down to 21. So either of those two could potentially be acceptable. Now here's the point. You're going to get a slightly different G depending on which tax rate you used. If you used a tax rate of 26%, your G is going to be around 4-ish. If you used a tax rate of 21%, you're going to get a G closer to 375. So again, this is why it's so important to articulate your assumptions, right? Because to be honest with you, I don't think anybody truly knows what their final tax rate is going to be. And it could actually be very different than 26 or 21. It could be 22, could be 27. But the point is we want to get a reasonable estimate. And for your purposes, I want that estimate based on some kind of guidance from the company. All right. Or somebody said they used the JP Morgan analyst report to get the tax rate. They didn't look at the transcript. But at least you're basing it on something that's real world. All right. So I'm going to use 21, but you could have used potentially 26. All right. So let's go back to Excel. So I'm going to put in here 21. Now the next thing that's very important is we got to do EBITDA and growth. And you'll notice for EBITDA, which one spikes dramatically, but number two goes back down to 16.1. Why does my EBITDA go back to 16.1 in 2021? Why does it go from 37.4 to 16.1? Yeah. Exactly. This is Boeing. And that's one of the issues you got to watch out for when you reuse this model. Because we had hard-coded into Boeing last week an EBITDA margin of 16.1% and a growth rate at the time I did this one of 7%. And that's going to carry forward. And by the way, this can really screw you up. Because if you're doing your valuation and you forget, for example, that you had last company share count or that there's a big change in margin that you just forgot to update, it can really make your life difficult because you're like, I had to put in some really crazy numbers to get this to match and it makes no sense. Oh yeah, I got Boeing share count. Or oh yeah, I got Boeing's margins. I don't have Coke's margins. So one of the things I'll recommend doing is I like to come in here and kind of clear it out by saying take 2021 equal the previous year and carry that forward. So that way I've kind of cleaned out some of the stuff that was historical. Right? And it's not that I want to necessarily say that that's right, but at least I'm closer than having some weird number from a previous company that is a completely different industry in my model. And by the way, we had talked about leaving some of these other numbers similar. Like, again, same thing. If I had said, oh, I changed net PP&E for this company because I thought the productivity would change, remember that that change is going to carry forward into your future models. So that's just a key point. All right, so this is giving me essentially a baseline for Coke. And so now, as I try and match these share prices, I need a more reasonable G. So this is where we needed to come back and do our G estimation under the assumptions. So again, to do an EV to EBIT multiple, we needed to know four things. We needed to know G, tax rate, ROIC, WACC. All right, so the idea is if we have our observed G, or observed EV to EBIT for the marketplace, which right now at Coke is, and actually because the share price might have changed, I'm going to go to this EEO, and this was the screenshot a few minutes ago. So here's the nice thing about Bloomberg, is that when you look at historical data, it's kind of in this reddish color, and you look at future data, it's more changes color to this kind of yellowish orange. All right, so here's the other thing. 2017 ACT actual, 2018 EST estimate. Okay, so I can clearly see this is a forward year, this is a historical year. So we're using FY2, forward year 2, count 1, 2, FY 2019. So somebody asked in an email this weekend, they said, are we using 2019? The answer is yes, because that is the second forward year for Coke at the time. But you can clearly see it. Again, make sure you're looking at annual data. Don't look at quarterly data by mistake. That will completely screw up your valuation because you'll have 1/4 of their revenue and 1/4 of their profits. Okay, so again, forward year 2. So for forward year 2 in 2019, their EV to EBIT based on that share price is 20.22. So I'm going to come back to my model and make that 20.22. As I said, I don't need to know the EBIT to calculate the multiple. So I basically now need to try and get my model to match the 20.22. So we've already put in a tax rate. We have a decent estimate of the ROIC. We put in the WACC, so now we're just trying to back solve for the G. So I can put in here 3%. Oh, by the way, that's too low. 4%, too high. 3.75. Now I'm getting really close. Okay, so somewhere around 3.75 is probably about the G the market has used. Now here's the key. This is an iterative process. I was trying to explain this to a student in the last class. And I said, if you remember we were building the model, and I said about 3 weeks ago that a circular reference is an invalid model, what we're actually trying to do is get around the notion of a circular reference. And here's what I mean by this. In order to calculate this multiple, we need to estimate a G, right? But in order to estimate the G, we need to know the multiple. So these two are somewhat dependent on each other, and that's the problem, is the share price drives the multiple, and we're trying to solve both simultaneously to get them to balance. So here's the key. We're close. All right, I'm not saying 3.75 is necessarily exact, and it gives us more of an estimate of a range. But here's the thing. If we think about it the way we originally did this, we're going to say, all right, I'm going to put my opinion in. Do I think their G is 3, 4, 5, 6, 3.82? I'm just making up a number. What we're trying to do is we're trying to actually work backwards to say, given an equation and a reasonable set of ranges, what's the approximate G the market's probably using? So plus or minus 10 basis points is probably the range in several different analysts. I'm not saying they're going to exactly get 375, but it's probably going to be 375, 39, 37. It's not going to be 5, and it's not going to be 2. Okay, and that's really what I'm trying to tease out here when I do my as is. But here's the key to the as is. It's not a complete as is because I am off by $4 and whatever it is, 10 cents in share price. So I'm still $4 off in share price, so I don't have a complete as is. And this is what I mean by iterate. Okay, and by the way, when I iterate, it's actually going to change the G to basically get them to match, so to change the share price. So my next step is, how do I get these share prices closer? Well, I'm pretty confident that I'm in approximate G. I'm pretty confident in my tax rate, pretty confident in my ROIC. What I'm less confident is the growth rate and the margins. Now, here's where it would have helped in this assignment. This is growth, this is EBITDA, if we had done the EIC. All right? So if you wonder why we do EIC, it's right here. Because what I have to do is I have to figure out what's the growth rate longer term and what's the margin longer term. And without really have thought through the 5 forces in the industry, I'm just doing a mathematical exercise, and that's not as valuable, right? Because again, if you really think about this at a macro level, what's the difference between this class and previous classes that taught you valuation? And the simple answer is this. It's not the algebra. Like, the algebra is easy. Anyone in this room can do the algebra, right? That doesn't differentiate the models, right? So it's never the math, right? It's not calculus. This isn't advanced quantum analysis. This is pretty much something a 12th grader can do, right? But the point is, what matters is not the math. What matters is the assumptions. Like, what assumptions do we use? Have we really thought through reasonable assumptions? That makes a good model. So let's put this in context. What's going to close the gap in the model of this $4 share price difference? And this is what I mean by, is it lower revenue or is it lower margin? Which of the two is it, or which combination? This is where we have to put in our subjective, somewhat informed opinion. So let's just think about if we had done an EIC, which of the two do you think it is? Yeah.
Probably going to be the lower margin, because if you look at their historical margins, they're somewhere around 24%.
Yeah. So again, we don't know enough about Coke. And one of the things Coke is doing is they're selling their bottling operations. So because they're changing their business model, that could actually mean this is realistic, but we don't know. Or it could mean the same thing though. What I do know is, as you said, is these margins are a lot higher than they were historically. And even if that's the case, here's the point. What we do know from the book is regression to the mean. Nobody maintains great returns forever. So to expect into perpetuity Coke to jump to the best margins they've ever had in a much more competitive market and keep that into perpetuity seems pretty optimistic. So if I had to close it, I'd probably agree with you that I'd probably close it more by margin than sales, but I also might close it by sales because Coke has a sales problem. What's Coke's sales problem? Yeah.
People drink Coke less
Why?
because they don't want the sugar.
Yeah, sugar. That suddenly my core product is now deemed unhealthy. And so if we extrapolate that into the future, it could also challenge some of their growth. So here's the point. I'm not saying you couldn't have done one or the other, a combination of both, but what I'm probably going to do is I'm going to lower my growth rate to closer to 3% to deal with the sugar issue. And that gets me down to 49. So I'm probably going to lower my margins. Maybe I'll call it 37 and then, I don't know, 36.5. See if that gets me close. I still have too high a share price. So 36 here, 36.5 here. Now I'm closer. I still need to go a little lower. So let's do 36. And 35.7, something like that. I don't know, 35.5. You get me there? Close enough. I'm in 50 cents. So here's the point. Two questions. One, I tamped it down gradually because I think that things don't happen always in just steps. But two, why did I do it in 23 more than 21 and 22? Why didn't I change this number as much as I changed this number? Why was that column more important? What's special about 2023? Because something's actually special about that year. Yes. Exactly. It's the beginning of the perpetuity continuing value period. So one of the things you're going to realize in a DCF is your continuing value is like 70 to 80% of the value for most of these companies. So what happens in 2023 is far more important to Coke than what happens in the 21 or 22 because those are just one-off years in a DCF, but the perpetuity is going to have the biggest impact. So that's also why 23 is a very important year in the context of our model because that's the representative going forward here. Okay, so just remember that as you're thinking through your assumptions. Yes?
Would it been incorrect to assume a higher growth and lower EBITDA margin?
Not necessarily. That's why your assumptions are so important in your write-up. So if you can justify higher growth and lower margins, I can't tell you you're wrong because I can't see clearly into a 5-year forward crystal ball with 100% certainty. And that's the point. Like part of this exercise is kind of tying assumptions to math and to numbers. Okay, and that's what we're trying to do. And as long as we're being reasonable, and so there's a reasonableness factor based on the real world, but nonetheless, you could have slightly different numbers. But by the way, and this is what I mean by iterating, when I do this, and now my share prices are closer together, notice my G's are off. Now I'm outside of a 10 basis point tolerance for G. So I need to actually get my G closer to 20.22. So instead of 3.75, it's probably more like 3.79 or 3.78. Which that gets my G's closer. And oh, by the way, am I still within $1? Yes, I am. So I think I'm comfortable, right? And this is what you all said to get comfortable with. Like, I can't tell you with 100% certainty that this is the actual G, but I know I'm close. And that's what I'm saying. This is like an apple that's red and an apple that's yellow. It's still an apple. This isn't an apple and an orange, right? I've used a reasonable confidence interval to say somewhere around here is the approximate G. Can't tell you exactly what it was, but let me just ask you. Who used a 21% tax rate in this room? Okay, what were your G's? Did anybody get a G that's dramatically different than this G?
I got 293.
That would be dramatically different. Outside of your 293, did most people get a G close to this within, say, 10 basis points? That was what I would expect. So the only way that you would get a 293 is if the other three variables were different. So you use a different whack.
I use the same whack. I had a higher ROIC.
So that would be the point. You'd have to have something different, and it would have to be rational as to why it would be dramatically different. Because at the end of the day, all we're really trying to do here is a DCF. And it's the cash flows of the DCF, because that's what we're driving here in the perpetuities. So what we're saying is, I need an approximate value, continuing value of 177 billion. What math gets me there? That's basically what we're trying to get back into here, right? So that's the point. If I have a lower G, I need an astonishingly higher operating ROIC to do that. That's the only way with a lower G that you probably could have solved that if you didn't change your whack. So as long as I think that that's a reasonable assumption, now I might challenge that assumption, but nonetheless, that would be the point. That's how we would have to think about this. That's why the vast majority of you probably got this range. Here's the thing. Anybody use 26% tax rate? What were your G's? And I'm going to guess closer to 4.1.
Yeah.
Yeah, 415.
Exactly. Because if you use the 26% tax rate, and I could put it right here in the model, ratios make this 26. The only way you get a 26% tax rate and you get those G's to match is that this G goes to 4.1, 415, something like that. And now my G's, well, looks like 4, whatever it is. What'd you guess? 4.1?
How close does it need to do the two ratios need to be together?
I want within 10 basis points.
So by like 0.1
So 4.05. But that's what I'm saying. Like if you said 4.05, 410, 415, not going to quibble about it. Because here's the real key to the model, which is you didn't say 3, you didn't say 6, you didn't say 5, and that would have been the point. Like 2 weeks ago, you were just gutting it. You're like, my gut feel says Coke should be about this. I'm not saying people don't do that, but what I'm trying to do is say we're solving a complicated multivariable equation, but with some reasonable assumptions. Like I said, I kind of knew what your G's were going to be at this tax rate. I kind of knew what your G's were going to be at the other tax rate, so just proxy it out. I know what JP Morgan's G's are going to be. I know what Wells Fargo G's are going to be. I know what Goldman Sachs G's are going to be because math is math. See, that's what we're trying to do is we're just kind of backing in to what assumptions make the math work. Here's the key. It's not at this point whether we agree with those assumptions. Right? We can do that when we do to our bull, our bear, and our target. This is just trying to solve the equation. So back to this, at a 3.78 G and the tax rate, that was 21. So change this back to 21. Then I have my as is, which I'll save, which is within my dollar and at the same time within a reasonable range of about 9 basis points. Dollar for the share price, and here 2 basis points for the EV to EBIT multiple. Now somebody might ask, and I'm surprised no one has done it, like, why are they out of sync? Like if I have the same multiple, shouldn't I have the same share price? Right? Because if you're not asking that question, I should probably put that in the midterm, because you should be asking that question. Right? So I'll give you 2 reasons why they're not exactly in sync. Number 1, EBIT. In this class, we're assuming a clean EBIT, right? Which means we're not putting non-operating items in the EBIT. We're not putting one-time items in the EBIT. In the real world, people do. Okay, so our EBIT, it may not be the exact same EBIT that an analyst is using because our EBIT is closer to an operating income EBIT, not a pure EBIT. Okay, and that could cause slight variance. Not dramatic, but it could cause slight variance. The other thing is how we calculate enterprise value. Our definition of enterprise value is more of a clean value than Modigliani-Miller, right? With Modigliani-Miller than what the analysts are using, right? Which is kind of a shortcut enterprise value. So for example, they're not breaking out in the cash, operating cash and excess cash. We are, okay? So our definition of enterprise value is slightly different. And so that could cause some nuances. right? So later in the semester, we'll make one more tweak to the model to basically sync up the multiples when we start talking about multiples to get kind of a Bloomberg equivalent enterprise value is what I'll call it. But here's the point. If I'm just trying to get a G, if I use the same academic formula on the real world math, I'm still going to get the real world G. And what I'm telling you is the real world G is not going to be all that different than the Bloomberg G. As I said, it's an apple that's either red or yellow. It's still an apple, but it's not going to be that far different. All right, and that's really why they may not exactly sync, but they're going to be close. All right, and the whole point of this exercise is to back in to those kind of key assumptions within reason that says, hey, Coke is looking at low single-digit growth, Coke is looking at dramatically expanded margins, and Coke is also looking at a G somewhere around 4%. That was what was the importance to get the as is, to understand the valuation. I'm going to pause. Questions, comments about what I just did? So again, as you guys did the homework, anything you struggled with that you want clarification, so you'll have no trouble doing this again in the future. Great. So at this point, you would save your file, and then you would create your bull and your bear. That should be your next step. All right. Now, here's the key to the bull and the bear. I saw an article recently that said there's some academic research that basically says that people that do scenarios with probabilities attached to them make better decisions than people that just forecast one number. All right? Because here's the thing. Every single person in this room has bias, and there's no way we can eliminate it. We just can't. We just have our own experiences, our own filters, our own points of views to making decisions, and you're just going to have a biased outcome. So that's the point. Your view of Coke is going to be jaded, right? And so what I'm telling you is if you use historical data, which many people do, you would completely miss Coke's sugar problem and real world, if we go back to the EEO of Coke, and you're seeing it this year, the drop in sales. Because you would just assume Coke's a consumer product with a great brand and tremendous customer advantage, tremendous market share that's probably not going to change, and it'd be hard to see that this year they're going to have a 10% dip in sales, right? So what I'm saying is our biases 2 years ago would never have predicted this because we would have never thought that sugar would be as much of a problem for Coke as it is today because it's new information. And so here's the extrapolation. That's why you're doing your bull and your bear. But number two, the reason I want you to do the bull and the bear is I want you to do assumptions first, numbers later, as opposed to numbers first and then assumptions, right? So that will lead you to a better assumption. Because if nothing else, even if you disagree with the bear, it will force you to at least think about something else that you might not have thought of that will reinforce a better ultimate valuation. So this is really to help you. Right? It's also helping investors, but it's helping you get a better forecast. So let's just talk about the bull. And I know we didn't do a full EIC, but what would be some of the things that in the next 12 months could lead to a higher share price from Coke, much better than where they are today? What would be some of those bull assumptions? Yeah.
They start making new recipes that are helping customers in their refranchisements. The bottlers are actually pretty successful.
And let's be even more specific, that the recipes involve things like alcohol and or whatever it's called, not the THC, but the other stuff. So essentially, and to some degree, their bottler strategy is more successful and it doesn't really hurt sales in the process. And by the way, just as an FYI, the reason they started buying bottlers, just interesting how pendulums swing, started with Pepsi a few years ago, is that Pepsi was noticing, particularly in non-US countries, the bottlers were actually starting to sell non-Pepsi products. And it was kind of pissing Pepsi off because they're just like, you should be pushing Pepsi, not other products. But as Coke and soda sales were slowing, they basically were looking for other sources of revenue. So what Pepsi did to control the supply chain is they started buying the bottlers. Because they're basically like, if we own you, then you're not going to put this other local Brazilian drink in here that's going to hurt our own sales. And then Coke started doing the same thing. But then it was really hurting their margins because bottlers have much lower margins than Coke and Pepsi did. And when the sales growth slowed and they weren't getting any uptick, now they're selling the bottler interest because it was killing their margins to get better margins. So again, it's like the pendulum has swung here, but nonetheless, a little backstory on what was happening with the bottlers. What else could be a bull scenario here for Coke that could really help them in the next 12 months?
We're talking about just margin or growth?
Margin and or growth.
In terms of margin, I know that the price shipping issues. This is like across all industries, especially with like Tyson's shipping. There are enough truck drivers to.
Okay. So how would that be a bull scenario in their case?
Currently, they're forecasting like really strong headwinds, but if the supply meets the demand and this is less of an issue moving forward, it could improve their margin.
All right. So again, I like what you said about the 5 forces. So you identified a clear force that's not just Coke. It's the idea of what's happening with freight and distribution costs. You've identified how that power of a supplier could be hurting them. And then here's the point. You're giving an option that says it may not hurt them as much as they think. And that could lead to a bull scenario. Like, I like that line of thinking. That's exactly what we're talking about when we do a bull and a bear. All right. So we have potential freight issues. There could be less freight, right, than they expect. They also have the potential of selling more, particularly of their diversification with coffee et al. That they just bought. What else could help them? Anything else that you guys put in your papers? I mean, the other thing is that this health thing isn't as bad as we think it is. That people decide it's unhealthy, but they keep drinking Coke. And particularly in emerging markets. Because our view, this is why I talk about bias, in the U.S. in particular, our U.S.-centric view is that people will not want to have sugar anywhere else in the world. Where in other parts of the world, you know what? That might be the only drink they have because their water supply is so horrible that it's actually good for them. And some carbs are better than no carbs, which aren't part of their diet at all. So I'm just saying that maybe we're taking our view and underestimating some of the growth that they could be achieving in other markets. I'm not saying I'm right or wrong, but that could actually lead to a bull. Okay, so regardless, think through that. Then, what would that mean for growth? And I'm not saying we're going to go from 4 to 10%, but maybe we'll go to 6 or 7. Okay, what would be some of the bear scenarios that we could consider for Coke? What is the thing that could go very adversely against them that could happen in the next 12 months? Yeah, that's right. The R word is back. One of the banks, it was either Goldman, Morgan, who basically said they're now putting a 50% probability of recession in the next 2 years, right? People just pay attention to that, all right? Because this raging interest rate rising is now permeating its way through the marketplace. So that could really hurt Coke as a consumer brand. What else?
Wait, what percentage did you say?
They said 50-50 in the next 2 years, probability of recession. One of the banks. It was one of the big banks. It was either Goldman or Morgan, JP Morgan or Morgan Stanley, one of the 3. What else? What else could hurt Coke?
The revenues could see some slight dips given the increase in competition. The Pepsi already existed in the marketplace, but they said in their earnings report that there's increased competition in the marketplace.
Yeah. So again, it's not just Pepsi. People are drinking, what's that flavored stuff? LaCroix? LaCroix, that nobody knows what it is, but they drink it.
It's very
But-
popular.
Absolutely. But I'm just saying, like, some of those alternative drinks that people are drinking get even more popular and take away. I'm just saying, have you walked into a Wawa or a 7-Eleven and seen how little shelf space Coke and Pepsi have versus where they were 5 years ago? I mean, in some sense, that's telling to what the struggles that you're describing with the competition. All right, what else could hurt them? We hadn't talked about so far. Yeah.
They could spend like a lot of money in R&D trying to introduce new products, and then the revenue doesn't really produce any revenue, so they push their margins down.
Coke coffee fails. The cost of acquisition. Coke alcohol fails. Look, it sounded great in Japan. They took it to the rest of the world, doesn't catch up. So, and oh, by the way, you think the beverage companies are going to stand by and let Coke take their alcoholic market share and get all that distribution? So again, maybe we're too optimistic there. All right, I'll give you another one. And this is just my old bias. And I admit I'm biased. All right. And in a very jaded way, and I'm sorry if it insults some of you here today, you have a different point of view. But what if the people who I disagree with in Seattle, in San Francisco, and New York start slapping taxes? These are the same people that eliminated straws, like, because it's killing the world. And I'm sorry, I just don't see it yet. But I'm just old. But that's the point. Like, they killed straws. New York banned the big gulp. How out of bounds is it that somebody puts a sugar tax out there? Not at the state level, but at a federal level. And not just in the U.S., but internationally. So same thing that happened to cigarettes, where suddenly Cokes cost $2 a can. All right, and there's this $1 excise tax that's been slapped upon them because governments are worried about sugar, and what they're going to do is they're just going to tax the citizens by making it really expensive to buy sugar. All right, so I'm not saying it's probable, but I think it's in the realms of possibility in the near term. You're going to make a comment?
Yeah, I was reading actually about a tax on soda in Mexico.
Yeah.
And I know like other countries are doing it.
Yeah, and I'm not saying under the Trump administration it's happening here, but it absolutely could in the next few years, and that could really hurt Coke. Yeah.
I was just going to say that one of the transcripts I read talked about sugar tax in the UK and South Africa.
That's absolutely. So what I'm saying is, when we start thinking about the bear, we just want to put in things that have slight probabilities. So even if I dismiss it and say, okay, not going to happen in the near term, I don't completely dismiss it as in the realm of possibility because, as you said, UK, Mexico, and who's the third country?
South Africa.
South Africa are already talking about this. And how long before the EU starts talking about this, and then eventually the US? So long story short, we think there are scenarios. We do our bull and our bear. It doesn't have to be symmetrical. And here's the point. What you're doing is a min and a max. Right? So what you're giving the investor is exactly what I'm saying. It's a min and a max. Here's how high I think it could be. Here's how low I think it can be. And here's the range that I've set for Coke over the next 12 months. And now your opinion is part of this. Right? Because in setting that max, you've translated this information into opinion for a high and an opinion for a low because you'll adjust your Gs, you've adjusted your ROICs by adjusting the sales and the margins. You could even adjusted the tax rate. All right, and if you really made the argument, slightly whack, but I generally wouldn't recommend doing the whack too much. But the point is, you now have a chance to have your opinion. So somebody said, do I have to use the same G across all four models? No. You're only back solving for the G and the as is. As you go to the other three, I would expect that your G could change. I would expect that in the bull you have a different G than a bear. And that would be the point. And that's the point. That's where you put in your opinion based on some of the assumptions you've articulated. Questions? All right, final part, your opinion. This is the target. Then you get to the fourth file. Now you put in an opinion. So again, in a previous class, somebody said, well, what I did is I went to the A&R, I went to the analysts, I looked at what the analyst said, and I tried to match what the analyst said, right? And by the way, that's not what I'm looking for you to do, right? I'm not looking for you to copy somebody else's homework and submit it. Like, that's not what I consider to be a target share price. Now, don't get me wrong. We can't be there's nothing wrong with being informed by what the analysts say, right? But you're not trying to replicate the analyst's opinion. You're trying to put in your own opinion. Now, maybe your opinion is similar to the analyst's opinion, but it shouldn't just be, I'm going to go copy the RBC Capital Markets Nick Modi's opinion and figure out a way to get $56. Like, that shouldn't be the way that you start your assumption on the target stock price. So that's not what we're looking for, right? I just want to be really clear on that. All right, questions about that? All right, the reason I say this is, and since this is actually being recorded on YouTube, I will be a little bit more guarded in what I'm about to say. But basically, I was working with a chemical company a couple of years ago. And this very big chemical company in Houston, Texas. And their largest shareholder was Fidelity. And at lunch, for a session I was in, senior management was in the room, and Fidelity came in, the actual fund manager that was the biggest shareholder, to talk to them about why he liked the company and what he was expecting for them to be an owner. And what was interesting is he actually had a piece of paper, and on his piece of paper, he had two columns. He had growth rates and he had ROICs, and actually it was margins, growth margins, ROIC, and then a multiple that would be calculated based on that, similar to the key value drivers. So what he was basically saying is, look, you tell me what your growth and return are going to be and margins are going to be, and I can figure out your trading multiple, and I can figure out whether I want to accumulate or sell your stock. And so it's just interesting to hear Fidelity kind of reinforce to a leadership team the exact messages we're talking about here today. But that's not the reason for the example. So management finished. At the end of the lunch, I was sitting in the back, and I was like, all right, they got to ask their questions. They had a couple minutes left. Everybody was done. So I raised my hand. I asked my question, which is, for any of these sell-side analysts, are there any of them that you respect as Fidelity? And he actually said yes, that there was one of the sell-side analysts who worked for Barclays, and he said, I completely respect them because basically I don't get to the Middle East much, my team doesn't get the Middle East much, and they know a lot about Middle Eastern chemical companies. And so they just have an expertise we do not, and for the chemical industry, they're our go-to people. Okay, so I really trust their opinion. And then I said, is there anybody you don't respect? And then he named the bank. And he named the analyst of the bank. He said, well, here's the thing. We do work with this analyst because they allow us to go play Pebble Beach anytime we want. And so we'll throw some business their way just so we can play Pebble Beach. But the analysts themselves, we know all they do is copy the spreadsheet of the other analysts. And then they basically just change the numbers a little bit. And that's actually how they do their earnings estimates. So we completely pay no attention to what they say, but we still throw some business to this bank just so we can play Pebble Beach. Okay? So again, this is, you want to know how sausage is made? This is real world. And that's what I'm saying is that, by the way, this analyst no longer works for this bank. Right? Because there's only so much playing for Pebble Beach that somebody's going to fund you with. You're not going to respect their research. And this is what I mean by copying another analyst and just back solving is not the point of this exercise, right? Because you're not going to keep your job. You're not going to advance in your career if that's all you do. So that's why plug and play is not good enough. And the analysts that differentiate themselves, those are the ones that people copy you because they know that you've thought this through and you understand these assumptions better than anybody else. You're not there yet. You're undergrads. But here's the point, practice. That's what I want you to do. That's what I'm expecting you to do. That's what I'm going to push you to do on the assignments. And that's what it makes a better as is target, bull, and bear. And that's why I'm pushing you to also constantly think through assumptions and do scenarios. Anyways, that was the assignment. I'm not going to put up the other 3 files. I think that makes sense. But that's at least how you do the as is. Questions, comments about any of this? Okay, so you may have heard a rumor about this. So we're done a little bit early today, and I don't have enough time to start multiples, which we're going to start in the next class. So extra credit, okay? So the extra credit assignment, you will have until 3:21 to submit. So you got about 25 minutes, right? It's individual, and what you're going to do is an as-is valuation individually on a company that you will submit. And you're going to submit 3 Bloomberg screenshots, so 4 total files. No write-ups, just as is, following the process we just did. No bull, no bear, no target, and the DES, EEO, and WAC screenshot. If you do that by 3:21, you can have 1 point of extra credit. If you don't, then you can leave now because there's no reason to work on the assignment because it doesn't hurt your grade. It can only help your grade. So your company, should you choose to do the assignment, is we're going to do Keurig Dr. Pepper. Keurig Dr. Pepper, yes. No. You can share data files, but you can't share screenshots. Okay, there's plenty of terminals in this room. All right, Keurig Dr. Pepper, make sure you submit if you're choosing to do the extra credit by 3:21 Eastern Standard Time. And by the way, you have to be registered for this section, otherwise you won't be able to submit. Because you only can do the screenshot or only can do this extra credit for the section time that you're registered for because this is time-based. Yes?
We need to submit screenshots.
You're going to submit 3 screenshots and an as-is valuation supporting those screenshots for Keurig Dr. Pepper.
Does that include a write-up?
No write-up.
My question, I'm in the 3:30 section.
So if you want to do the extra credit, you have to come back.
Okay.
Because unfortunately,
Okay,
it is
that's
time.
fine.
Yeah, you have to come
So
back.
it's like 55 minutes in.
I would say come back about 4:20.
Got it.
All right. So ticker symbol KDP, U.S. equity. And as of right now, it should have been available for you to see the assignment as of 1:50 p.m. So it should be available. And again, you need to, sorry,
None of the computers available are working.
3 o'clock. So, sorry, it'll be available at 3 p.m. to submit, and you need to submit by 3:20. So you may need to do some sharing. So as soon as somebody finishes it, just basically hand over the computer, just do the screenshots on the computers that are here. And if computers aren't working, please let me know because we need to let the IT people know to fix this before Wednesday's class. So put a sheet of paper, just put a sheet of paper, does not work. And I'm going to ask them to try and fix it before Wednesday because obviously we have a few broken machines. All right, so again, we're done with the class today. If you wish to do the extra credit, you're welcome to do it. If you don't, we'll see everybody in class on Wednesday to talk through the multiples and the multiples assignment.